Isn't it interesting to see that it's not just the U.S.? There's this synchronized global story going on right now. And now you've got firms like Goldman Sachs and Barclays talking about 4% global growth next year. Is that what you're seeing globally?
No, actually, if you look at why it happened, it's all down to energy. The energy rebound has been driving almost the entire pickup of growth in the developed market economies. It's been driving around 80% of the rebound of prices and consumer inflation. And so really the big story behind it is the oil rebound, which has been very important for investment. You know, you could almost say what China is to trade in the global economy, energy is to investment. And energy-related investments, particularly here in the U.S., are really the biggest part of what is behind these numbers.
Wow,
positive numbers.
You know, I hadn't really looked at that. That's a really interesting point that you make. And look, UBS, the largest wealth manager, $2.5 trillion in assets right now. How do you invest? What do you tell clients right now who are looking at these markets and saying, okay, things are good, but we're talking about $5.5 trillion in market value gain just since the election here in the U.S.?
Yeah, but you also talked before, there will most likely be very soon a tax reform, and that will basically help corporates a lot. So we expect if tax rates go down to something like 20%, this could easily mean that we get another 10% move in the next couple of months on the equity markets up. Because, you know, corporates will invest. They can basically claim 5 years of investment costs up front, and they're going to pay much lower taxes. A big tax reduction of corporate taxes is going to do really well for the stock market.
Let's talk about that, Axel, because the truth is some people have problems with the individual side of this tax plan, but it's the corporate side of the tax plan that really is being seen as having the impact. You're a business manager, chairman of the largest asset manager out there, or wealth manager rather, and you're talking about this actually moving the needle on the economy. Yeah. How does that happen? You think that companies will see a 20% corporate rate and then they will say, okay, with that money saved down from 35%, I'll invest more in the business and hire more workers?
They'll invest more in the business. You will also see corporates that have been basically showing profits abroad. There was a big discussion about base erosion and profit shifting with very high taxes in the U.S., more favorable taxes abroad. That is getting reversed. So you'll get higher tax income, you get more investment as a result of that, and the dynamic effects will be positive. It's very hard to say at this point whether actually the 1.5 trillion increase in debt that you also talked about, whether that would not short-term lead to an increase in debt. Medium to long-term, it's going to positively influence fiscal behavior as well.
How do we know that the companies are actually going to hire more workers and invest in the business and not just buy back stock? Is that a worry? Or, as President Trump said once, that's okay too?
Well, as I said before, so even if they do the later, it will be a very positive on the stock market. And so
that's true, yeah.
What I talked about is basically it will provide some further momentum. And, you know, asking what do we tell our clients, you know, this is not the point in time where you want to move out of your investments and go liquid. The economy still got 1 or 2 more years to go. The Fed, in my view, will continue to raise rates slowly. So, you know, probably do, you know, 1 more rate rise this year. We're only expecting 2 next year and maybe 3 the year after. But at that point in time, short-term rates will be at around 2.5 to 2.7. So, you know, quite a different rate. That's probably around neutral, and that's probably as far as the Fed will get in this cycle. We're expecting the economy to show somewhat more weakness 2-3 years out, but over the next 2 years, it's still going to look a pretty good environment.
I want to get back to the Fed in a second because I want to get your take on the winding down of the balance sheet. But in terms of allocating capital, you had a strong quarter just recently, even in the emerging markets business. So are clients also looking internationally, not just the U.S., in terms of buying stocks?
Well, it's particular our client base. You look, every second billionaire in Asia is a UBS client. So we're a very strong bank, not just in the U.S., where we have 20,000 people, but also in Asia Pacific. And at the moment, you saw a lot of dynamics, in particular in emerging markets. And that's been very favorable. As rates continue to normalize, emerging markets will normalize as well. But some of the Asian Pacific markets have been pretty dynamic. And, you know, the bigger issue there is the emergence of millionaires and billionaires, because if you look on the technology side, if you look at how Asia is catching up, you know, most of the population of the world now lives in Asia Pacific. So it's a great consumer environment. And for us as a financial intermediary, that's a good place to be. So it's more our regional composition in the business that helps us.
That's incredible. But by the way, in terms of the Fed, are you worried that they have to wind down a $4.5 trillion balance sheet? Is that going to be a disruption?
They can make it less disruptive by basically phasing it in over a very long period of time, and that's what they're doing. I think what you will see is there's going to be a lot of treasuries placed in the market over the next 3 to 4 years. I think the plan the Fed is currently following is not going to be very disruptive. Our plan, looking at the Fed, we actually pencil in that the Fed will start buying treasuries again in 3 years' time, because most of the 10-year programs the Fed did actually will mean that in order to limit what rolls off the balance sheet, the Fed has to control that, and being, partly buying, in particular if they want to let all the mortgage-related stuff roll off the back, they might have to buy some treasuries 3 years out. So they're going to control it in a very clear fashion, and I think there's no uncertainty now that we've seen the transition at the Fed leadership that would see a lot of continuity in this program. So there's not going to be an acceleration of that program. At least we don't expect that.
As a former head of the Bundesbank, you're watching global markets, you're watching the Federal Reserve. It sounds like you're quite comfortable with where they're going.
And well, we're not concerned about the course. I mean, the Fed has taken very dragged out steps to normalize interest rates. Given that we come out of the largest crisis in financial markets, this is probably an appropriate action. The one thing that for me is a big question mark: how will the Fed react if there is a big fiscal stimulus program? Because in the past, they've actually made noises that if there is other forms of stimulus kicking in, they might have to revisit their own. And that's something where it's very, very early to say, because we don't know the program yet.
Really, really good point. Real quick on Bitcoin. Any plans for Bitcoin trading at UBS?
No, we don't, and we observe the phenomenon with very much cautious. We warn clients that this is something that, unlike a currency, there is nobody that controls the supply of it. So for me, it's not a currency. For me, it is an investment, and it is an investment that has no intrinsic value. It's a transaction device, and people have to be cautious if they look at it as a store of value or as an investment that has long-lasting value.
It's pretty extraordinary what's happening in Bitcoin, isn't it?
I think it's a massive journey up, but I wouldn't exclude that what we saw yesterday is more frequent. That there could be sporadic moves where actually the market falls a lot.
Dr. Axel Weber, great to see you, sir. Thank you so much. Chairman of UBS.